Welcome back to the deep dive. Today, we're really getting into it, looking at the UK property and mortgage market. It's a sector under, well, immense pressure right now, and that's dictating the cost of living for millions.
Exactly. And our mission today, really, is to give you the clearest but still deep understanding of the specific stress points. We basically got a diagnostic report here from the sources showing what kicked this all off. The ripple effects for, well, pretty much everyone involved, and crucially, how the smart money, the investors, are trying to adapt.
Yeah, we want to cut straight to the core mechanics, because understanding this isn't just about the scary headlines. It's about seeing a fundamental shift in economic policy and whether the market even works anymore. And our sources, they're pretty clear on where it all started. Okay, so let's unpack this. The big thing, the catalyst for all this stress, it's the rapid rise in interest rates. That directly sparked this huge mortgage affordability crisis. And that connection, that cause and effect, that's really the anchor for everything else we need to talk about.
It really is. It's the foundational shockwave. And for you, the listener, it's important to see this not just as like a temporary cash flow problem, but as a systemic repricing of risk right across the UK financial system. When borrowing costs jump that much, that fast, it just fundamentally changes the numbers for homeowners, for people trying to buy renters too, and even the big investors. All at once.
So let's call this first bit the affordability avalanche. We know the cause is the rate hike, but let's focus on that immediate tangible effect, the crisis point that almost stopped the market cold.
Well, what's fascinating and a bit terrifying is how quickly that rate change actually travels through the system. It turns into what people call a huge payment shock. So when the Bank of England pushes up its base rate, anyone on a variable mortgage, bang, their monthly payment goes up instantly. But the real stress point, the big one, is the millions of households whose fixed-rate deals are ending.
Exactly. They signed up maybe 3-5 years back when rates were crazy low, maybe 2%.
Rock bottom, yeah.
And now they're looking at remortgaging at maybe 5, 6. I've even seen 7% mentioned. That change isn't small potatoes. It can literally double what you pay each month.
And that jump just completely changes the whole question of buying a home, doesn't it?
Yeah.
It means the bottleneck isn't really about, say, building enough houses anymore.
Or no.
It's about finding anyone who can actually afford the loan needed to hold the debt on that house. This massive shift in debt capacity, well, that's why we saw transaction volumes just seize up so fast.
The math just stopped working.
Pretty much. For the average person trying to get on the ladder or even just stay on it by remortgaging.
Okay, so if the affordability avalanche hits borrowers first, here's where it gets really interesting, because the pain doesn't stop there, does it?
Not at all.
Once that financial pressure is in the system, it spills over super fast into the rental market. And that creates what our sources are calling the double squeeze.
Yeah, the double squeeze.
Yeah.
The immediate hit, as the sources clearly show, is that renters just get slammed with higher costs. It's the most obvious downstream effect.
Right.
You've got a market where landlords, especially the ones with buy-to-let mortgages, they're now dealing with the exact same crippling rate increases we just talked about.
And landlords, when their own costs shoot up like that, they've basically got two choices, haven't they? Either they suck up the loss, which, let's be honest, most can't do for long,
Right.
or they pass that cost on to their customer, the renter. But digging into the sources, it seems the pressure on landlords isn't just about the interest rates. It's like a double whammy.
It absolutely is. It's the rate increase, yes, but it's compounded by a specific set of tax rules, fiscal rules.
Okay, this sounds important. This detail often gets missed, right?
Really does, yeah. It's critical, but often glossed over in general media chat. So for a long time, landlords could deduct all their mortgage interest payments from their rental income before they calculated their taxable profit.
Right. Treated it like a normal business cost.
Exactly, like any other business. But that changed.
It did. The government phased that out.
That's right. The sources remind us they phased out that full mortgage interest relief, and they replaced it with just a basic rate tax credit. And that's where this specific extra pressure point comes from.
Okay, hold on. Why does that distinction matter so much? Basic rate credit versus full deduction.
Because it completely changes the financial sums, especially if you're a higher rate taxpayer. Instead of cutting your taxable income by the full interest amount, say, £10,000 interest just comes off before tax.
Okay.
Now, you calculate your tax based on the gross rental income, the full amount, and only later do you get a 20% tax credit back on the interest.
Oh, wow.
So, in effect, you're being taxed more like on your turnover, not your actual profit after financing costs.
So a landlord could suddenly look like they're making a massive profit on paper, pushing them into higher tax brackets, even if their actual cash flow after paying the mortgage interest they can't fully deduct anymore is tiny or even negative.
Precisely.
Yeah.
That's exactly it. So when you combine that specific pressure from the existing tax rules, this sort of fundamental blow to the old buy-to-let model's viability, with the sudden, really steep rise in interest rates,
Yeah.
you create what can only be described as a truly toxic operating environment for, being a residential landlord.
Yeah.
That is the definition of the double squeeze.
It really paints a picture. It's systemic because both sides of the rental equation are getting hammered at the same time. The landlord's squeezed by borrowing costs and these pretty tough tax rules, and the renter, they're squeezed by the price hikes that inevitably follow all that pressure on the landlord.
It's a nasty feedback loop.
Yeah, powerful and destructive, and it just makes the whole affordability challenge even worse.
And that synthesis, understanding that interplay, it's crucial for getting the current market mood. When property investment becomes less about stable long-term income and more about navigating tricky tax policy and volatile rates, well, it just destabilizes the whole sector.
Okay, so what does all this mean for the big players then? The capital, the money that actually fuels the housing market, it doesn't just sit on the sidelines while the traditional buy-to-let thing becomes, well, toxic.
Absolutely not. Investor capital is very sensitive to risk, liquidity, and regulatory headaches.
So we're shifting focus now to the investor pivot. What are the really sophisticated financial players doing in this kind of environment?
Well, our sources confirm they are actively looking for alternatives. They're pivoting away from traditional direct property ownership. Buying a single house or flat, renting it out yourself.
Getting away from that illiquidity and hassle.
Exactly. Trading that in.
And the sources are pretty specific about where that money is going instead. Looks like two main alternatives are popping up.
That's right.
First one is REITs, real estate investment trusts.
And the second is the growth in property crowdfunding models. And both of these, interestingly, offer solutions to the problems baked into direct ownership right now.
Okay, let's break down the REIT appeal first. Why is buying into a REIT suddenly more attractive than owning a couple of buy-to-let flats, especially with high rates and those tax rules we talked about?
Well, REITs kind of tackle the tax and the debt issues together. A REIT is a corporate structure, right?
Yeah.
They fund their property purchases using a mix of equity selling shares and corporate debt, not those high-leverage personal buy-to-let mortgages. That corporate structure shields the income from those punitive individual landlord tax rules we just went through.
Oh, okay.
And crucially, they also have to distribute most of their income to shareholders. That makes them attractive to investors looking for yield.
Right. So an investor gets exposure to a whole portfolio of properties, maybe hundreds, but they sidestep the personal grief of high mortgage rates and that complex tax squeeze.
Exactly.
And it solves the liquidity problem too, presumably. Selling shares in a REIT is quick. Selling a house, not so much.
Months, yeah. You can sell REIT shares almost instantly. And the crowdfunding angle, that sort of tackles a different part of the financing problem.
How so?
Crowdfunding lets investors pool their money together for specific projects, maybe a new development or buying a block of flats. And often, this can bypass the traditional banks altogether.
Cutting out the middleman in a way.
Yeah, it can reduce the reliance on those expensive, rapidly changing institutional mortgages.
So what we're seeing is a clear move away from a system built on individuals taking on lots of debt and trying to game the tax system towards these more structured, diversified ways of investing in real estate. Things that are less sensitive to, sudden rule changes like that landlord tax thing or immediate rate hikes.
And if we connect this to the bigger picture, this pivot isn't just about dodging a temporary period of high rates,
Right.
It suggests maybe a fundamental shift in how investors view real estate risk in the UK. They seem to be trading the sort of perceived security of owning one tangible brick-and-mortar asset
Yeah, the safest houses idea.
for the actual security you get from diversification and professional management that these structured products like REITs offer.
Okay, so let's quickly pull all that together for you listening. It kicked off with rising interest rates. That quickly caused a massive mortgage affordability crisis, that payment shock hitting people hard. That financial pressure then spilled straight into the rental market, creating the double squeeze. Renters hit by higher costs. And landlords getting crippled not just by those high costs, but also by those specific pre-existing tax rules, the limited mortgage interest relief making things much tougher.
And this toxic mix, this confluence of negative factors, has actively pushed sophisticated investors to pivot. They're looking for alternatives like REITs and crowdfunding.
So understanding these specific pressure points, like how monetary policy, the rates, interacts with fiscal policy, the tax rules, to create that double squeeze, that's really crucial if you're tracking the UK economy, the property sector, or even looking for future investment angles.
Absolutely.
Which brings us to our final thought for you to chew on. If we see this clear shift documented in our sources towards structured investments like REITs and crowdfunding every time the traditional market hits a crunch like this,
Yeah.
what does this current situation really imply about the long-term risk perception of traditional direct property ownership in the UK? I mean, is this switch just a temporary hedge while rates are high? Or are we actually seeing a permanent shift, the kind of institutionalization of real estate investment that could sideline the individual landlord model, maybe forever?
That's the big question, isn't it?
Yeah.
Definitely something worth watching as the economy keeps changing. Thanks for diving deep with us today.